You bought a broad market ETF. You thought you were diversified across hundreds, maybe thousands of companies. You're not. Right now, if you own SPY, VGS, IVV, or any S&P 500 tracking ETF, more than a third of your money is sitting in just 7 companies. And almost all of them are betting everything on the same thing: artificial intelligence. And here's the part nobody is talking about. The bill for that bet is now $725 billion a year in capital spending on infrastructure these companies have never built before, chasing returns they haven't proven yet. And it's about to get worse, because one of the most expensive stocks ever to list on a public exchange is about to IPO. And if it joins the S&P 500, your ETF will be forced to buy it, whether you want it to or not. Today, I'm going to show you exactly what's hiding inside your ETF, why more ETFs doesn't mean more diversification, and what you can actually do about it.
Let's start with a number that should make every ETF investor uncomfortable. The Magnificent Seven: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla now represent 34.3% of the entire S&P 500 as of December 2025. That's up from just 12.3% back in 2015. Let that sink in. 10 years ago, these 7 companies made up roughly 1/8 of the index. Today, they're more than 1/3. And because the S&P 500 is market cap weighted, meaning the bigger you get, the more of the index you own, this concentration has been quietly building without most investors even noticing. Think about what this actually means for you. If you invest $10,000 into VGS or IVV today, approximately $3,430 of that money goes directly into 7 companies. The remaining $9,570 is spread across the other 493 companies in the index, some of which get less than 0.5% of your money. In 2024, the Magnificent Seven accounted for 79% of the S&P 500's total return for the year to June. So when the index went up, it wasn't because 500 companies were thriving, it was because 7 were on fire. And that's the trap. When it works, you look brilliantly diversified. When it doesn't, and 7 stocks all fall together, there's nowhere to hide. Now, here's where it gets really interesting, because all 7 of those companies are doing the same thing right now.
Every single one of the Magnificent Seven is currently making a massive, unprecedented capital bet on artificial intelligence. And I mean massive. As of the most recent earnings reports, the 4 biggest hyperscalers, Meta, Amazon, Microsoft, and Alphabet, have collectively guided for approximately $725 billion in capital expenditure in 2026 alone. That's up from $320 billion in 2025. The money is going into data centers, Nvidia chips, power infrastructure, and AI models. Across these hyperscalers, combined capital expenditure rose from $162 billion in 2022 to $448 billion in 2025. The acceleration is extraordinary. Now, capital expenditure is not a bad thing. Companies invest in growth. That's normal. But what's unusual here is the scale relative to the returns being generated. Investment in AI is now at $332 billion in capital expenditures in 2025, for just $28.7 billion in revenue. Read that again. They are spending $332 billion to generate $28.7 billion in AI revenue. That's a return of less than 9 cents for every dollar spent, at a stage where these companies have never operated data centers at this scale before. Now, I'm not saying AI won't eventually pay off. It very well might, and for some of these companies it already is. But here's the important thing to understand. This is a capital-intensive exercise these businesses have never done before, at a scale the world has never seen, chasing a payoff that isn't yet proven. And if you own VGS, IVV, or any S&P 500 ETF,
you are along for that ride. Every dollar you put in is implicitly endorsing that bet. Goldman Sachs has even flagged that this AI spending is crowding out the shareholder returns investors expect. The Magnificent Seven have invested $368 billion in AI-related capital expenditures, which Goldman Sachs expects will limit a substantial increase in buyback payouts. Less money for dividends and buybacks, more money for data centers. But that's just the known risk. There's a new one coming.
SpaceX is about to IPO. SpaceX is targeting a valuation of $1.75 trillion on listing day, which would make it larger than Microsoft, trailing only Apple and Nvidia, despite posting a $4.28 billion net loss in Q1 2026 alone and an accumulated deficit of $41.3 billion. Now here's the problem for ETF investors. If SpaceX lists on the S&P 500 at that valuation, index funds are obligated to buy it. That's how index investing works. The index adds a company, every ETF tracking that index must purchase shares to maintain its weighting. You don't get a vote, the algorithm buys. At an expected valuation of $1.75 trillion, SpaceX's price-to-sales ratio would be approximately 93. For context, the S&P 500 currently trades at a price-to-sales ratio of around 3, and the Nasdaq 100 at around 5. That means you'd be forced to buy a company at 93 times its revenue. Not 93 times earnings, 93 times sales. A company that is currently losing money. At $1.75 trillion, SpaceX would trade at 94 times sales, higher than any existing S&P 500 stock. Palantir, which currently has the highest price-to-sales multiple in the index, trades at 67 times. And what is SpaceX doing with all that money? The same thing as the Magnificent Seven, AI. Out of SpaceX's nearly $21 billion in capex spending last year, $12.7 billion went to building out data centers for XAI. That's more than the company spent building rockets or satellites. So your ETF could soon be forced to buy, at the most expensive valuation in S&P 500 history, a company that is losing money, majority controlled by one person who can't be removed, and spending more on AI data centers than on the rocket business it's famous for. That's not diversification. That's concentrated AI exposure by another name. Here's where most Australians make the mistake. They see the concentration problem, they buy another ETF, and they think they've solved it. They haven't. Approximately 70% of VGS's holdings overlap with IVV's. If you hold both, you're essentially paying two sets of fees on largely the same underlying stocks. If you hold VGS, IVV, and NDQ together, you're not getting 100 new stocks, you're getting heavier positions in the same US tech giants you already own. VGS, IVV, NDQ, and Qual all hold Nvidia, Apple, Microsoft, Amazon, and Alphabet in their top 10. This is the illusion of diversification. You look down at your portfolio, you see 4 or 5 different ETF tickers. You feel diversified. But underneath, it's the same 7 companies, over and over. So what should you actually do? 3 things. First, look at what you actually own. Not the ETF name, the underlying holdings. Every ETF provider publishes a full holdings list on their website. Check your top 10 positions across all your ETFs combined. If it reads like a Magnificent 7 Greatest Hits album, you have concentration risk, regardless of how many ETFs you hold. Second, use a tool that shows you the overlap. ShareSite's portfolio tracker shows your consolidated holdings across multiple ETFs in a single view, so you can actually see your real exposure, not just your ticker list. Morningstar's X-ray tool does the same thing. There's no excuse not to know what you own. Third, consider balance. This doesn't mean selling everything and starting from scratch, but it might mean adding genuine diversification. Australian shares via VAS, international small caps, bonds or real assets that don't have the same AI concentration hiding inside them. You don't have to predict whether AI pays off.
You just have to make sure you haven't accidentally bet your entire portfolio on it.
ETFs are still one of the best investment vehicles ever created. Low cost, liquid, accessible. That hasn't changed. But an ETF is only as diversified as the index it tracks, and right now, the world's most popular index is more concentrated in fewer companies, all making the same bet, than it has ever been in its history. That doesn't mean sell everything. It means know what you own. Check the overlap, build genuine balance, and don't let the word index fund make you feel safe when a third of your money is riding on 7 companies building the same AI data center. Wealth wisdom. If you found this useful, leave a like. It genuinely helps this video reach more people who need to hear it. And subscribe if you want to keep building a portfolio that actually works. I'll see you in the next one.